Here's a number that stopped me cold when I first read it. Not the $2 trillion valuation you keep hearing about on television, not the stock price speculation, not the pundit predictions. The number that stopped me was buried on page 11 of an actual legal document filed with the United States government, $28.5 trillion. That is the size of the market SpaceX told the SEC it intends to go after, and they called it, in their own words, the largest actionable total addressable market in human history, larger than the entire US economy. And nearly every piece of financial commentary I have seen since that filing dropped has been focused on entirely the wrong thing. So let me try to be useful here and talk about what actually matters. Now, I want to be upfront with you. I am not here to sell you anything today. I am not going to breathlessly predict that this stock goes to the moon, forgive the pun, by next Thursday. What I'm going to do is walk you through the actual mechanics of how this thing works, where the real risks sit, and what an honest, clear-eyed investor ought to be thinking about before they put a single dollar near this IPO. I've made a lot of mistakes in my investing life, and almost all of them happen when I let excitement override analysis. I would hate to watch you make the same ones. So let us start at the beginning. When most people hear SpaceX is going public, they immediately think rockets. Fiery, beautiful rockets landing themselves back on launch pads like something out of a science fiction novel. And look, that business is genuinely extraordinary. The ability to reuse a rocket is not just an engineering achievement. It is an economic transformation. Think of it this way. Imagine every single time you flew from New York to Chicago, the airline blew up the plane after it landed. Every flight, a brand new plane. That is what the rocket industry looked like before this company came along. Every launch consumed the vehicle. The cost was staggering. And this company figured out how to land the rocket, refuel it, and fly it again. That changes the math of getting things into orbit so dramatically that it has essentially made every other launch provider on Earth uncompetitive. That is a real moat. That is the kind of durable competitive advantage I've spent my life looking for. But here's the thing. The rocket business, as miraculous as it is, represents only a small slice of what this company is actually building. When I looked through that SEC filing carefully, and I mean carefully, the way you read a contract before signing it, not skimming the headlines, what I found was a business model that has three distinct layers, and each layer is bigger than the last. The first layer, rockets and launches, they project at roughly $370 billion of addressable market. That is a meaningful business. That is not nothing, but it is the smallest of the three layers by a very wide margin. The second layer is connectivity, internet service delivered from space. They call it Starlink. And right now it has approximately 10 million subscribers. 3 years ago, it had 2 million. That is a 5-fold increase in subscriber count in less than 3 years. And the growth is not slowing down. It is accelerating. Think about what this product actually is for a moment. You are somewhere remote. Could be a farm in rural Kansas. Could be a boat in the middle of the Pacific Ocean. Could be a village in sub-Saharan Africa with no fiber optic cable for hundreds of miles in any direction. And you point a small dish at the sky and you get broadband internet. The traditional telecommunications companies spent decades and hundreds of billions of dollars burying cable in the ground and erecting cell towers to deliver something similar. In populated areas, this company bypasses all that infrastructure entirely. It goes over the top, literally, and their cost structure to deliver that service is fundamentally lower than anyone who has to maintain a ground-based network. Right now, 61% of SpaceX's revenue comes from Starlink, not rockets, internet. The third layer is the one that has Wall Street squinting and scratching its head. And honestly, it is the one that I think is the hardest to value with any precision, but also potentially the largest. That layer is artificial intelligence and data infrastructure. The company is building what I would describe as the future backbone of the AI economy. And they are positioning themselves as the only entity on Earth with both the capability and the economics to build data centers in space. Now, before you dismiss that as science fiction, I want you to sit with the practical logic for just a moment. Running a data center on Earth has two enormous costs: electricity to power all those computer chips and cooling systems to prevent those same chips from melting. These are not small costs. They are existential to the economics of running AI in space. You solve both problems simultaneously. You have permanent solar exposure, free electricity 24 hours a day with no clouds, no weather, no intermittency, and the ambient temperature of space is roughly negative 270 degrees Celsius. That is free cooling on a scale you cannot engineer on Earth for any price. The only missing piece was a company that could get large, heavy equipment into orbit affordably and repeatedly, which, as it happens, is precisely what this company does better than anyone else on the planet. So they have filed legal documents with the US government stating their intention to build non-Earth-based data centers capable of delivering 100 terawatts of compute per year. And if you think that sounds audacious, well, yes, it is. But I have learned in my life that when a very capable team makes a very audacious claim inside a legal filing with federal criminal penalties for misrepresentation, it deserves to be taken seriously. That $26 trillion AI opportunity is what pushes the total addressable market to that number that stopped me cold. 28.5 trillion. And before anyone out there says they will never capture all of that, you are right. They will not. Nobody captures an entire addressable market. But here's the math that should make you pause. If they capture 10% of that figure, that is approximately $3 trillion in annual revenue. The entire S&P 500 index today generates around 18 trillion in revenue combined. 10% of SpaceX's addressable market gets you to 1/6 of everything. Every major American public company produces minus from one company. That is why the valuation conversation is not really about $2 trillion. That is the entry price. The real question is where the ceiling is. Now, let me talk about something that I think is being systematically misunderstood in most of the coverage I've read, and that is the question of what happens to the stock after it goes public. Because I've watched a lot of IPOs in my life, a lot. And the pattern that repeats itself most reliably is this. Company goes public at a high valuation. Insiders who own shares for years are finally allowed to sell after a waiting period. They sell in large numbers. Stock drops. Retail investors who bought into the excitement get hurt. It happened with Uber. It happened with Rivian. It happened with a long list of technology companies that I will spare you from reciting in full. And the reasonable question to ask is, why should this be any different? I want to give you an honest, structural answer to that question, not a promotional one, an honest one. The first reason is taxes. If you bought shares in this company 20 years ago for nearly nothing, and today those shares are worth $100 million, selling them triggers a capital gains tax event that, depending on your state, could consume 33 cents of every dollar. That is a $33 million check you are writing to the government. Now, very wealthy people do not volunteer to write $33 million checks unless they absolutely have to. And the thing is, they do not have to. They can borrow against the shares instead. A major bank will happily lend a large shareholder $15 million against the $100 million position in a publicly traded company. They charge interest, maybe 4%. The shareholder walks out with cash, pays zero tax. Because borrowing money is not a taxable event and may even be able to deduct the interest, the shares stay put. That is not a loophole. That is just how wealth actually works at scale. The people who have been waiting 20 years for this company to go public are not going to throw away a third of the proceeds to the IRS if they can help it. And they can help it. The second reason is a rule change that I find genuinely interesting. Nasdaq quietly revised the criteria for index inclusion this past May. Previously, new public companies had to wait 3 months before being added to the Nasdaq 100 index. That waiting period has been shortened to 15 days. They also removed a requirement about minimum public float. meaning the percentage of shares actually available to trade. And then they added something that, if you will forgive me saying so, reads as though it was written with this specific company in mind. If your public float is below 20% of total shares outstanding, your index weighting gets multiplied by 3. Here's why that matters. There are trillions of dollars. Your retirement account may be among them, sitting in index funds that track the Nasdaq 100. When a stock gets added to that index, those funds are legally obligated by their own rules. To buy it, they have no discretion. The algorithm buys. So picture this. SpaceX lists publicly with only a small fraction of total shares available to trade because most insiders are holding and borrowing, not selling. Meanwhile, within 2 weeks, hundreds of billions of dollars in automatic, rule-driven buying must purchase SpaceX stock. Tiny supply of shares available. Enormous automatic forced demand. That is not speculation. That is arithmetic. I would compare it to a situation where only 10 people in town have lemonade for sale on the hottest day of the summer, and suddenly 1,000 people are contractually obligated to buy a glass. The price of lemonade does not stay where it started. Now, I promised you I would be honest about the risks, and I intend to keep that promise. The largest risk, and I say this with genuine respect rather than criticism, is also the company's greatest asset, the individual human being who controls it. When you have a founder who owns 85% of the voting power and who is simultaneously running multiple companies, some of which are generating political controversy and public disagreement at a fairly consistent clip, you have a concentration of personal risk that is unlike anything I have encountered in a large public company. The business is extraordinary in large part because the person leading it thinks in ways that very few people can match and executes at a pace that almost no organization can sustain. That is a genuine strength, but it means that if something disrupts that person's involvement in the early years of this company's public life, whether that is health, politics, distraction, or something none of us can predict, the business does not simply continue on autopilot. The personality and the company are not yet separable. That is a real risk. I do not know how to quantify it, but I would be doing you a disservice if I pretended it did not exist. The second risk is valuation patience. When a stock is priced to perfection and a $2 trillion debut valuation for a company still in aggressive growth mode is priced for significant optimism, there is very little room for execution, stumbles. If Starlink subscriber growth slows unexpectedly for a quarter, if a launch goes wrong in a very public way, if the AI data center ambitions face technical setbacks, if interest rates make borrowing less attractive and force some insider selling that the market did not expect, any of these could cause a meaningful correction from whatever price the stock opens at, and corrections hurt people who bought at the top. What I would say to anyone considering participating in this IPO is this: understand what you are buying and why. Not because someone on the internet told you the stock is going to triple, not because your neighbor mentioned it at a barbecue, not because the financial news has been talking about it constantly. Those are not investment theses. Those are invitations to be someone else's exit. A genuine investment thesis for this company might sound something like, I believe that low-cost satellite internet is going to be adopted by hundreds of millions of people who currently lack reliable connectivity, that this company has a 10-year head start and structural cost advantages that competitors cannot replicate quickly, and that I'm willing to hold this investment for at least 5 to 7 years through the inevitable volatility that comes with any early stage growth story this large. That is an investment thesis. The rest is noise. Now, people often ask me about picking individual stocks, and I always give the same slightly boring answer that I genuinely believe. If you are not a professional investor willing to do deep analysis and hold with conviction through discomfort, an index fund is almost certainly your friend. And in this particular situation, there's an interesting structural argument that owning the Nasdaq index fund, the kind that tracks the 100 largest companies on that exchange, gives you automatic exposure to SpaceX inclusion without having to time anything or pick a price. The rule changes we discussed mean that within 2 weeks of the IPO, those index funds are buying SpaceX regardless. If you already own the index, you are along for the ride. You do not need to rush into the IPO at whatever price the opening day excitement generates. You just hold the index and let the mechanics do their work. That is not glamorous advice. It rarely is, but it has a significant advantage of having actually worked historically for patient people. Let me say a word about the CEO compensation structure, because it contains something I find genuinely revealing about how this company thinks about its own future. The filing describes performance milestones that must be achieved before the founder receives a majority of his compensation. One of those milestones is a market capitalization of $7.5 trillion. The IPO is expected to price the company at roughly $1.75 trillion. So the compensation structure is designed around the assumption that this company grows to be 4 times larger than it starts. Those where management's financial interests are clearly and durably connected to shareholder outcomes. This is one of those situations. There's also a lockup that I think deserves mention. Most insiders will be restricted from selling for 180 days after the IPO, but the founder's lockup is 366 days, a full year plus 1 day. There is no obvious legal or financial reason for that extra day, except that it sends a very clear message. This is someone who is not planning to take his money off the table anytime soon. And when the person controlling 85% of the voting power has voluntarily chained himself to the stock for a year, that does tell you something about where he expects it to go. I want to return briefly to Starlink, because I think it is systematically undervalued in the current conversation, and it matters for how you think about the whole company. Traditional telecommunications companies built their businesses over decades by putting cables in the ground and towers in the air. That infrastructure cost them hundreds of billions of dollars. It is also infrastructure that is largely stuck where it is. It cannot be efficiently extended to the billions of people on Earth who live beyond the economic reach of that ground-based investment. Satellite internet from low Earth orbit essentially leapfrogs all of that. You do not need to run cable to a village in rural Pakistan or a fishing community in northern Canada. You point a small receiver at the sky, and Starlink is already providing direct-to-phone service in partnership with existing carriers. I mean, it is going to have news cycles where the headlines are bad. The people who ultimately do well with investments like this are the ones who understood the thesis well enough to hold to the noise. And the people who get hurt are the ones who bought on excitement and sold on fear. I started this conversation by telling you that a number on page 11 of a government filing stopped me cold. $28.5 trillion, the largest actionable market in human history by their own description. I want to end by reminding you that the number on page 11 is not a promise. It is an aspiration. The distance between aspiration and reality is where investing actually happens. And navigating that distance requires patience, honesty, and the willingness to think independently rather than follow the crowd. The crowd is already talking about this one, which means the question for you is not whether SpaceX is a great company. It is whether you understand it well enough at whatever price you are considering to hold it through whatever comes next. If you do, wonderful. If you do not, that is not a character flaw. It is just a signal to keep reading before you commit. The best investment you will ever make is still the one you understood before you made it,